to another episode of the Straight Up Chicago Investor Podcast. I'm 𝗤𝗏𝗃𝗃. With me, as always, is Mark Ainley. Mark, how's life over at GC?
Not bad. Not bad. We are hiring. So again, you might have heard the commercial on the podcast or see our blast. If you know anybody that's looking to work in real estate, whether it be we're looking for a leasing agent right now, we're looking for property managers. So anybody out there that friends, family, licensed, unlicensed, we're looking for people to help GC grow. So what about you, Tom? Like you have, I think you finished up rehab. You're growing over there. Tell me about that.
We're busy. As I mentioned on previous episodes, I joined up with Drexel Properties, and we've had a few closings here, which has been great. Then I personally closed on a 3-unit that we're finishing rehab. It kind of ties into our story today. We have a great lender on the show, but man, this was one of our quickest refis, and it was, we were very proactive about it, right? What do you need from me? Let's get it all in there before we're done. Don't wait till the end of the rehab to reach out and say, okay, we're ready. Let's go through the process. I mean, we were pretty much ready, all on board, and then just waiting for the appraisal. And we can ask our guest today, a lot of times the delays, whether you're purchasing or doing stabilized debt, a lot of it's self-inflicted on the borrower, I feel. There's a lot you can just do ahead of time to get out in front of that.
Yeah, definitely. I think a lot of that, people underestimate what they don't know when it comes to financing. We'll talk about a lot of that stuff today. So the stuff that you're buying, are you buying the newer stuff to hold it, or what are you doing with that?
Yeah, anything that's single families we flip, anything else we're holding.
Nice. All right.
What do we got for the housing provider tip of the week?
All right, housing provider tip of the week. Right now is a weird time of the year. By the time this airs, it'll be early March, middle March. And what you have right now is freezing and thawing overnight. So it's not, you're getting a lot of ice from it's raining, just being springtime, or things melting during springtime, and it's freezing overnight. So not saying you have to run out to your property for every time you think it could be icy, but maybe you stash a bag of salt in the entranceway or the rear porch for your tenants to maybe spread some salt when they think it's slippery. So like tip of the week, throw some salt on your property and the tenants will hopefully help reduce some of your risk. Now, the one thing about that is come June, make sure that bag's not there, because that looks bad for when you're trying to rent units and there's salt all over your front hallway and so forth, because kids played with it. So you got to get it out of there before the springtime ends.
I like it.
All right. Today's guest, we have another returning guest. Our guest today was on episode 44, and we talked about financing. We talked a lot about house hacking and the loans that you can get with that. But today we have a producing area manager of neighborhood loans. Now on the first episode 44, he was under a different company. And for you guys that are listening, it was kind of funny. He just changed companies over to neighborhood loans, and he started recording the podcast, and behind him was a huge sign that he literally hit pause and ripped it off the wall. It was pretty cool. So without further ado, want to introduce Chris Puleo. So Chris, tell us kind of how things are going these days in your world. Sounds pretty busy.
Yeah, it is, we're gearing up for the spring market. Obviously already started, kind of still seeing last year's supply and demand issues off towards the end of the year, kind of starting up again. So, a lot of agents, customers contacting us early and often, just trying to make sure they're pre-approved, actually going through the underwriting stages, even sometimes before they make an offer. So that way their offer's a little bit stronger than most of the other ones that are going out there. So we are really busy right now. We're excited. Great opportunity for our team, my office for neighborhood loans. We're excited. We're building out a brand new office in Schaumburg. So we're going to have a big grand opening. We hope to see a lot of the podcast guests that are local, to come out on that grand opening when we get to that. So, we're really excited. We think it's going to be a great year. It's going to be crazy, but it is going to be a great year.
Well, talk about crazy. We were talking last week. You used the word volatile. This is almost a volatile market when it comes to talk about rates and so forth. Kind of give us some insight to what you're seeing on your side out there.
Yeah. So there's a lot of sticker shock in the market right now. People are used to, the last couple of years, during COVID, where rates were suppressed down into those under 3% range. Right now, you have a lot of volatility because not only do you have inflation hitting the market, you also have this Russia-Ukraine thing that's happening right now also. So what you're seeing any day, whenever you're comparing interest rates between lenders, you have to compare rates and costs. And we're going to get into that a little bit later. Just because when rates come out at 8:30 in the morning, they could have changed 3 times by 11 a.m. Okay, so rates, customers have to get used to that. Primary resident rates, they're back up into the upper 3s, low 4s, depending on your portfolio, and that's okay. That's something that I always say. Everybody wants low rates, but everybody wanted COVID to be over so we can move back to some normalcy, right? So just make sure your lender is calculating your payments using a high-end estimate, always giving you a worst-case scenario, so it's always better as you move forward. Rates one day to the next. 2 weeks ago, sorry to cut you off there, Mark, but 2 weeks ago, we saw a 0.75% swing up and down, back and forth over 3 days. That doesn't usually happen over the course of a full year. Okay, so just realize it's very volatile out there. Make sure your lender knows what they're doing, keeping you informed, and also has a float down option. That way during the process, you can always get the best rate available.
Well, today's February, just for reference, because some of these things are moving targets as far as what you're saying, but it's February 23rd. By the time this airs, it should be middle March or so. And hopefully Russia will either invade or go home, whatever it might be. And that'll be done as well, too, by the time this airs. But so are you saying that, COVID kind of created an artificial low in the rates? Is that, that's just.
Absolutely. So what the government did is when COVID first hit, one, there was a flood. Usually when the stock market, and I say usually because it doesn't always happen, usually when there's volatility or an unsettled market, what happens is money rushes out of stocks and into the safe haven of bonds. Okay. So when money is coming out of the stock market and into the bonds, that actually pushes interest rates down. Okay. So that's very, very important, because then as people have more consumer confidence, what happens is those rates then get taken out of bonds, right? That money flows out of bonds back into stocks. Okay. So when this first happened, there was a combination of a couple of things. The world economy was worried about what would happen to businesses during COVID. So money flowed into bonds, pushing interest rates down. Then you also had the government buying mortgage-backed securities, the Federal Reserve. Also, keeping interest rates low. The Fed obviously continued to cut interest rates to nearly zero. So all those factors put together caused interest rates to be really low to help the economy continue to grow and push forward. Now, because of that, right, money isn't free, right? So when you do all these things and the government starts spending money and do these things, what happens is inflation starts to hit the market. That's where we're at right now. So inflation is starting to come in. It's at a 22-year high in the last report. We expect inflation to kind of keep in that area, and we expect the Federal Reserve to start raising rates to help offset that.
Why would inflation create? Just give me the 101. Why does inflation increase rates, I guess?
Well, the cost of money. So, for example, I could use this example. For 2 years ago, it cost you go to Home Depot, it cost you $3. You go to Home Depot right now, it's $15, right? So what's happening is the supply and demand and the cost of money is more expensive compared to the worth of the dollar, right? The United States has printed more money in the last 18 months than it has in the previous 100 years. Okay, so if just like anything else, the more money that's in supply, the less the value is of that dollar, right? And that's what's causing inflation to go up. And the government had to do that. I'm not blaming this as a political statement, right? They were doing their best with the information they were given to help the economy and to help people who were out of work, giving more unemployment benefits, more tax incentives, letting people not make mortgage payments for many months. So when that costs money eventually. You got to pay the piper eventually. And that's what's happening right now. And you're going to see interest rates probably continue to rise a little bit here over the next 6 months. We think the worst of it's over. We also think the Federal Reserve is going to be raising rates, which most of the time people think, oh my God, that's mortgage rates. That's just one factor. In an inflationary market, I think if the Fed raised interest rates even all the way up to 1% it would actually push interest rates a little bit lower because that helps offset inflation, right? So if inflation is causing mortgage rates to go up and the Fed acts, that could actually be a benefit for mortgage rates and home buyers.
Got it. I want to go back to something you mentioned, Chris. In a volatile market, I feel it's in your best interest to lock in. And it sounds like you have a program where you can lock into your rate. And if things do bottom out, you have an option where it's technically not a rate lock. You have an option to go, I locked in at 4 and now rates have dropped throughout my loan process and it's now 3 3/4. So can you talk, am I correct in saying that? And can you just talk through that a little bit? Because it sounds like you should lock today then, right? Like there's only upside. You hedge against rates going up and you get the benefit if they go down. Is that correct?
That is correct, with one little caveat. Okay, so you're only allowed one float down during the process. Okay, and usually it has to be at least 0.25%. Okay, so that's what lenders that do have float down options allow you to do. I am a big fan. If you are comfortable with your payment, no matter where the interest rate is at, when you sign your application or when you sign that contract, lock that in. Okay, because you can always float down at least once during the process. So there's now if rates go up, you're protected, right? So that's the thing. We're always worrying about worst case scenario. So if you're comfortable with that payment, we do have that float down option, which is huge because again, if rates go down with how volatile it is, you might see in a day where right now something happens and the market shifts 0.5%, not 50 basis points, but an actual 0.5% interest rate. You want to be with a lender that can do that for you. And that's very, very important. But again, you only get to do it once during the process. So just, I get that when rates start going down the other way. Oh, well, can we float down again? No, now you're stuck. So, and there's no cost to do a float down. There's no cost, to lock in, so I am a big fan. I don't play the game. And that's going to get down to one of our future topics when we call about bait and switch and comparing lenders, because a lot of lenders will tell you one thing and then it's another layer down the road.
Got it. And one more question from those intro comments. So you mentioned Feds are probably going to be raising rates. As just a normal consumer, are there any things, I've heard, the 10-year treasury, are there any sort of indicators that I can look at as a novice to say like, ooh, this is a good indication that rates may or may not be going up? Or is it just too convoluted to really make an accurate prediction?
Oh, it is convoluted with how rates are done, but there is, for the common person, what I always say is go to cnbc.com and look up the 10-year treasury. Okay. When rates were at their lowest, that yield was somewhere around 0.35 to 0.4. Okay. Right now we've been hovering plus or minus 2%. Okay. So that shows you right there. If you just want to follow that, again, there's the Fannie Mae coupons, and there's some other things that affects the federal funds rate. There's a few different items that actually end how you end with the last rate. But that is a great indication for the common person who doesn't understand anything really about the market, how interest rates are determined, to really just follow that 10-year treasury. The lower that number is, the lower rates are. Okay, the higher that number is, usually the higher or the direction of which rates are going. So again, that's a good just indicator for people to follow. And I usually say about every 15 basis points on that 10-year treasury represents about 0.125%.
Is everything that you're saying relevant to a guy in New York or a guy or is this all specific to Chicago?
How is this relevant to them?
Well, everything we're talking about here, I guess so far, the rates and what to look for and inflation. Like this is not just specific to Chicago. This is anybody anywhere.
Oh no, this is definitely nationwide. So when interest rates come out, it is nationwide. But for some of your even podcast listeners here, they've also benefited from the inflation. And what I mean by that in the supply and demand shortage, because as many of you know, rentals are at an all-time high, right? When you go and try to rent something that was $1,500 5 years ago, you can get $2,000 right now. Okay. You're excited to get that $2,000 a month in rent that you used to only get $1,500, but now you're going to come and complain to your lender. Well, now it's costing me $200 more on the interest side, right? So it kind of goes, just have everything, a perspective of everything. If you can get $500 more in rent right now because of that's how the market is, you can't complain that it's costing you $150 or $200 more on the interest side because you're still plus 300 from 5 years ago, right? So especially in those multi-units, investment properties, a little bit different than primary residence, take advantage of the high rents and lock those leases in, but then also don't be so upset when your interest rate is a little bit higher than it would have been 2 years ago because you're still offsetting it. It's either a net zero or you're still ahead. That's why it's such a great time still to get into the rental game, just because the cost, the amount of money you can get for rents these days still is so much more than what the mortgage payments are on those properties.
Cool. Good point. Thanks for pointing that out. You used the term bait and switch. Your industry has a reputation for that bait and switch. That just because all the damn disclosures you got to put underneath every single advertisement that you see. Like there's literally 7 lines of small, tiny print. So that's always a red flag to me. Like, all right, this industry is got some snake oil salesmen in it. So not to paint the whole everyone in a bad light, but talk to us about kind of what people need to watch out for this whole bait switch, because you guys advertise rates everywhere, and all it takes is somebody to advertise a half a percentage less, and that guy will get that much more traffic. But I don't think that one person can do anything different than most of you guys. So kind of give us some background to that.
That's a great point, because here's the thing: we all get our money from the same place that we're borrowing, right? And when you hear the advertisement over the weekend on the radio when you're driving, that had to be in on Wednesday. I just told you about how volatile the market is, up and down, and rate swings every single day. So what happens when rates start to go up? If the first thing your client or a customer asks me is, what is your rate today? That's the wrong first question to ask. Okay, because what can happen is, if let's say rates today are 4%, to throw out an even number, and all you're looking for is something under 4%, I can deliver that, but what changes is the cost. There's something called origination points or discount points. So if we're all getting our money from the same place, it's just how do you package those costs? So the real question when your client is asking, hey, what would be my rate in this scenario? And also, what would be my origination charges, or Section A of the lender's estimate? Because Quicken Loans or those online lenders always have super, super low rates. And I'm really appreciative, because they're one of my best referral sources of people that get mad at them. Because they'll get something that says right now when rates are 4%, 3.5%. And they're like, oh, I'm going there. I got 3.5%. I'm like, okay, send me your lender's estimate. And I say, see this $7,000 in origination charges you're paying? All they did was buy down your interest rate. Okay. So never ask a lender as the only question, what's your rate today? Okay. The real question should be, please give me 3 options: a rate with 1 point discount, a rate with no points, and a rate with 1% credit. Okay. What that credit does is just offset some of the costs that you could be entailed in a purchase. And if your lender is unwilling to do that, then they're not willing to tell you the full story. And that's what's so important when we talk about bait and switch. You call me, hey, Mark, thanks for calling. Oh, yeah, you want to know my interest rate? Oh, okay. Why? That's very important to you. Okay. 3.75. Oh, wow. That's better than I've ever called. I'm going to send you my stuff. Great. I'm going to do the application, Mark, get it over to you. All of a sudden you get that application. There's so many documents. The normal consumer can get lost in that and not even realize what they're being charged. Okay. And I hate to say this about our industry, but it's true, because you have a lot of loan officers who are not big producers, that 1 or 2 loans that month is the difference between them paying their bills or not. And they're going to tell you anything that you need to know to try to get that deal, right? So make sure you're going with somebody that does a lot of business, that gives you options, where your loan isn't the most important loan to them to pay their bills, because then they can be honest with you and truthful and make sure that they're putting you in the best position possible.
Are you seeing right now, similar to what we saw in 2005, 2006, a flood of new mortgage brokers coming onto the scene just because the real estate market's hot, similar with real estate agents. Are you seeing that now as well?
2 years, we've seen a lot of that. I'll talk about 2005, 2006 on that side, and then also the fear of a lot of questions I'm getting about a possible housing crash also. And you're seeing a lot of realtors, a lot of loan officers who all of a sudden are licensed, all of a sudden came in because, right, you can put an ad in, you can post up on Facebook, I'm doing loans, give me a call. Okay, but what's going to happen as rates continue to rise or stabilize, if they don't have that past clientele or realtor referrals, they're not going to be able to last. You know this as well as I do, Mark. You know, back in the day when I first started 20 years ago already, I was the donut guy, right? I'd bring donuts to all the real estate offices. They were all there on Fridays. They're looking at the open house books for the weekends and everything else, right? Well, even pre-COVID, we've shifted so much to technology that there's not that many agents that come into the office every day. So how are these new loan officers who've swooped in, how are they going to continue to develop new relationships to be able to get more referrals to represent themselves? So you're going to see a mass exodus over the next 2, 3, 4 years of loan officers and agents who probably won't be here. And that's actually a good thing. That's a great thing for the market. We gain market share. The more knowledgeable people are in the industry to truly help customers. The second part of that is I'm getting a lot of questions on, oh, should we sell? We're worried about a housing crash, just like after, 05, 06. The biggest difference, do I think there'll be some retraction? Possibly, but it's not going to be a crash because one, supply and demand. There are so many clients that are still looking for houses that were pre-approved over the last 12 to 14 months that until there's more supply than demand, you don't have to worry about depreciation. Okay. They're so much more well capitalized because of the Dodd-Frank laws and different lending laws. We're not giving out 100% stated income interest only loans anymore, right? Those were the original product had good intent, but what it went to was a disaster. So because of that well capitalization, also because people had such low interest rates, whether they refinanced or not, go back to the rental market, right? If you have a house mortgage right now at $300,000 at 3% interest, you're not going to be able to rent that same size house at the same mortgage payment you have because the interest rate is so low. As opposed to back then, you had interest-only products coming due. You had negative AM loans coming due, interest rates on adjustable rate mortgages jumping up, where it made more sense. Hey, I'm going to let go of my house because I could rent for $1,000 cheaper, right? That right now, because so many people refinanced in the last 2 years, I really don't see it. I can see maybe over the next 3, 4 years, some stagflation in home prices, maybe little pockets, a little bit of a decrease, but nothing to be concerned about as a home buyer.
It's interesting because I think I've changed my tune to that topic of, is there gonna be a crash? Just because there's nothing, there's a lot, there's the whole supply and demand, the lack of new construction being built, and the amount of capital that's out there, and the responsible loans. Tom, you talked about this last night when we did the presentation, just the responsible lending that's out there. I mean, it's still, you got to jump through a lot of hoops to get loans. Now they have different programs that are coming out, but even those different programs that are more aggressive are still probably the more conservative ones that were in 2006.
Oh, for sure. There's actually down payment requirements. So, as opposed to before, you can have these crazy programs and just qualify,
Yeah. No, I remember I said this last night, walking away from a closing where I put nothing down and walked away with $10,000 because I asked for the credit on the contract. So that was my rehab money, actually. I had 110% loan to value.
Yep.
So let's talk about some of the more 110, Jesus. Let's talk about some of the more responsible programs that are out there, right? So we have a lot of, people looking to buy their first house hack who are, FHA, but what are some other low down payment options or some other alternatives to having to put 20% down that aren't FHA?
If you're going to be owner occupying the home, okay, there is a misconception. A lot of things have changed over the years. You can get a gift whether you're going conventional or FHA. If you're below the median household income level for your area, there's something called Home Path or Home Possible, which is actually 3% down conventional. There's down payment assistance programs. We're a verified IDA lender. Also, if you're a first responder, stuff like that, check with your unions, check with your counties. A lot of times there's grant money that people they're not even aware of it. Also, a lender such as myself, any sort of first responder, I give a $1,500 credit to. Ask those questions to the people who you're talking to. So yeah, there's the FHA 3.5% down, conventional 5% down, 3% down, 10% down, 15% down. The program that's right for you is really based upon your credit profile. The credit score adjustments for conventional loans are so dramatic with rate compression, where if you have a 680 credit score, that can hit your rate right now on the conventional side by 0.75% compared to FHA where there's no adjustment. So if you have less than 20% down, that's the other question to ask your lender. I want a side-by-side comparison conventional to FHA. What would my rate and payment be here? What would my rate and payment be there? Because there's a lot of misconception about, FHA has higher mortgage insurance. Not if you have a 680 credit score. It's the same or higher, and your interest rate is higher. Now, if you have a 740 credit score and you have 5% down, you should be going conventional because your overall payment would be less. So that side-by-side comparison should be explained. Here's my professional opinion. Here's what I think is best for you. You make your offer based upon what you feel is best for you, but here's my professional opinion.
I imagine most lenders like yourself have the ability or have the tool to easily spit out a side-by-side comparison for something like that, right?
It's 2 check marks in our loan software.
Gotcha.
It's very simple.
That's why you're the producing area manager. That's why. You used the word gifting. Can you explain how people can utilize gifting as a tactic to getting loans?
Absolutely. So gifting, there is no limit on gifts in the mortgage world. Okay, I am not a CPA. So if somebody is going to give you a gift, I always say, hey, check with your accountant, make sure that there's no issues there for the person who's giving you the gift. How you get a gift, you just have to document it. This is very important because many people run into problems. You go to your parents and say, thank you so much. You're going to give me my 5% down payment as a gift. We have to document it. It has to be either a copy of a check, wire to the bank, wire to the closing, but then you also have to show that person's bank statement. And that's where things get tricky because especially that older generation who don't trust anything, they're going to say, I'm not giving you my bank statement, or they give me a bank statement with the account number blacked out or something like that, right? So one of the requirements of the gift is you have to show the paper trail of the deposit, and they have to sign a gift affidavit. And then you also have to supply the bank statement in which that gift is coming from. Okay, so that's the only kind of thing where some people get caught up. You have some people who are giving the gifts that get a little bit weird about giving their information out. So just realize that up front that will be required. But there is no limitations on gifts. You can give 20% for a 20% down conventional. There used to be conventional. You used to have 5% of your own money. They have since done away with that, where you can have your whole down payment as a gift, even if it's less than 20% down.
So the important piece is just paper trail. You can't bring cash up from south of the border and not have a paper trail. So,
and people try.
I bet. COVID restrictions. There's a lot of restrictions that as a backstop or safeguard lenders put in place, or it might have been Fannie that put in place when COVID was really going through the prime in 2020 and 2021. What restrictions were in place that are now lifted that people don't have to worry about?
The biggest one, which was difficult, to show, one of the restrictions was you had to show not only a year-to-date P&L and balance sheet, which is normal on any self-employment loans, right? They're always going to want to see your numbers that are on track from previous year taxes. But to coincide with that, Fannie and Freddie also said, we want to see 3 months business bank statements to show the deposits and that your job or is continuing to work through this COVID time. That was a very difficult situation for many people that said, look at these low rates. I want to save money, but my business is shut down. I get their business bank statements. There's no activity, right? So, Fannie and Freddie would say, well, you're obviously not operating your business. Therefore, we're not going to approve you. Okay. Since I'd say about a month or two ago, they have lifted that restriction of showing business bank statements. So all you need to do is just do a year-to-date P&L and balance sheet, which makes it so much easier. You also needed a letter from your CPA stating that that COVID has not restricted your income. That also since has been lifted. Okay, so you'd have CPAs that are being put in a very uncomfortable position of, their clients need to save money or they can go under, having to write this letter that may or may not be true. And it just created a lot of frustration for self-employed borrowers. So we're very thankful that that's been lifted because there's enough paperwork for self-employed borrowers to begin with. So that being lifted has really helped quite a bit.
Continuing on the path of self-employment products, I know that's something that's loosened up a lot in the last few years. What's that game look like now for a self-employed person trying to get either owner-occupied or investment conventional type financing?
Great question. So, couple things. There is with COVID and some income has been down, right? No doubt about that. And if you haven't been self-employed for at least 5 years, you have to go 2 years bank statements. Usually is how we get the automated approval. If you've been more than 5 years, sometimes you can get an approval to only use 1 year business bank statements to qualify. So again, you want to get pre-qualified with your lender to see how much they have to use. If you don't qualify, businesses have been booming, I would say the last 12 months, compared to the previous 12 months. There are 12-month bank statement programs where they literally add up the deposits over the course of those 12 months, right? And divide by 12, and that's what they use for your income, which is crazy. But it is a great product for self-employed. There are requirements, though, unlike, again, 2005, 2006. You do have to have good credit scores. You have to have 20% down usually. And the rate is a little bit higher than market. But it's done in such a way for self-employed where okay, the next 2 years are going to be back to normal. I'm going to be able to qualify for a regular loan. Even though my rate, if the market rate is, let's say 4%, is now 4 3/4 on this product. Once you get your 2 years tax returns back to where they need to be, you can always refinance out of that. Shameless plug, anybody that does a purchase with me, any refinance in the future, I waive all closing costs for. I'm a big believer at the volume I do. I want to have relationships with my clients and know they can come to me at any time. There's all these different products for self-employed, especially that one. That's the biggest one that I think you're going to see this upcoming year, because 2 years ago was still that real bad COVID year that nobody knew what was going to happen. A lot of companies shut down. Where the last 12 months, you could use those deposits, still get into a great home with a decent interest rate that's only going to get improved.
Got it. So, Chris, we've talked a lot about owner-occupied situations. Let's say we're purchasing something we're not going to be owner-occupied, 4-unit, 6-unit, 8-unit, whatever that might be. Talk through some of the programs and expectations there. Obviously there's going to be more money down, but just give us like the 101 on if someone called you, and I know there's a lot of variables, but just give the high level and we can go from there.
Absolutely. So a 2 property, you are allowed conventional wise. Let's just talk conventional first.
Sure.
2-unit, non-owner occupied. You can go 20% down. There are some alternative programs that will allow for 10% down. I don't suggest those because the costs and interest rates are very high on those, which make your cash flow worse. I want to do 20% down. Same thing on 3 and 4 unit properties.
Before you go on, is there a debt service coverage ratio, which I know is kind of hard on 2 units?
Not on residential. There is not. Residential, you're qualifying just as if you're buying on your debt to income ratio, and you are allowed to use 75% of the rentals of market rents to qualify.
Got it.
Okay, so that's very important to know. 3 and 4 units, Fannie and Freddie say you need to put down 25%. Okay. So there is an increase on that. Anything above 4 units is considered commercial. That's where the debt service, and that's where the actual property is underwritten before the borrower is, if that makes sense. The borrower still wants to get pre-approved. However, a bank determines the value of what a commercial property is in their mind. Okay. So if they do the cash flow, debt, the debt service ratio, they look at everything, they might say, well, this can be financed and we have a value of $800,000 on it. Well, the seller's listing it at $1 million. None says you can't buy it for $1 million, but the loan to value is going to be based upon an $800,000 purchase price because that's what the debt service value is allowing for it to cash flow out. So commercial, totally different animal than residential. Residential, we pre-approve the clients. Commercial, we pre-approve the clients still because we know your credit, financial information, but the property becomes more important to be underwritten before a commitment letter is issued than the personal property itself.
Got it. All right. You mentioned getting 75% of the rents when you're doing, 2-unit, 3-unit, et cetera, getting credit for 75% of that. So here's a very Chicago question. Okay. 2-unit, non-conforming. You have the garden unit down there. It's not a legal 3-unit. I know you probably don't get credit for that income, but we've heard stories of, rip out the sink, FHA going in there and making them rip that apartment up. Just talk through if you're preparing someone, let's say it's owner occupied, they're house hacking. What would you tell them before that appraisal, what to expect?
The first thing I would do is make sure if it's a non-conforming, let's say 3-unit, okay, make sure your realtor is basing the comps of your offer off of other 2-unit properties, not 3-unit properties. That's the biggest place where people get into problems. Appraisers cannot use a 3-unit comp versus a conforming 2-unit with an illegal unit on the third floor basement, underground basement. So that issue right there is the number one issue because the owner says, no, this is a 3-unit property. Therefore, 3 units are going for $700,000, but 2 units are going for $500,000. The best that 2-unit is going to raise out at is $500,000 because it's not a legal conforming 3-unit. Okay, so that's very important. There is the issue, and there's no way around it. You cannot have anything that's gas in the basement. If there's a full kitchen and it's not electric or gas, that they will make you rip that out and cap off that gas line. Okay.
And is that when you say is that FHA only or pretty much any conventional lender?
95%
roll the dice
because it's not now if it's okay, my old Italian grandma has an electric stove in the basement and a kitchen to make extra Christmas cookies. Okay. Nobody's living down there. Right. And it's electric, not gas. Okay. The problem comes with if somebody's actually living down there with those issues, you are going to run into appraisal problems. And a lot of times, not the whole thing has to be ripped out. It has to look like a basement. And if there's a gas line down there, it's going to have to be capped off.
Got it. Yeah, because we've heard different degrees of what has to be done down there, which I probably somewhat appraisal specific.
And it's the appraiser that catches that, right? That's who's going to bring that to light. Like there's no sliding past that because the lender didn't catch it, right?
No, because the appraisal is going to be reviewed by the underwriter. Gotcha. I mean, unless the appraiser doesn't put it in his report, but most likely they're going to take pictures of all 3 levels. And if they see that there's a kitchen down there and 2 bedrooms, they're going to say, well, is that a basement or why is there a kitchen, a bathroom, and, different pictures on the wall, of a different family, you know what I mean? So, so just be careful with that stuff. What I say is, there are some different ways to get around those things, depending on the lender you're working with, if they're direct to the agencies or not, if it's owner occupied compared to investment property, changes some of the specifications. That's something you want to talk to your lender, get your lender involved with your agent. Say, hey, here's the listing. We're worried. What can we do to get around it? And, if you have a good lender, hey, I'm going to go sit down with the head of underwriting. Say, listen, we have an investment property purchase. Here's the file. What has to be done to make sure it passes Fannie or Freddie? to make sure we can get that done. Or if it's owner occupied, if they're going FHA, that's a different thing. But the biggest thing, make sure the value carries on the proper amount of units that it's registered as.
Is it easier for an investor to get a loan on a refi or a refiing cash out or a straight up refi purchase?
For an investor to get a refi cash out?
Let me put more context to it. So I've seen a lot of people, or I recommend to a lot of people that if they have another property or the personal residence where they got 100 grand there, they can buy something cash, or 200 grand, they pull that out, they refi with you, pay cash for the new property. But how is the rates higher if you're refinancing out and pulling the money out at that point, or is it better to just purchase and get the loan from up front?
I guess reframing this, Mark, if I'm hearing correctly.
Thank you.
Is there a premium paid for a cash out refi compared to a rate term?
Yes. So let me get this in context of investor versus an owner occupied. Okay. So in any cash out refinance, I usually say is about 0.5% over the market of a rate and term refinance or a purchase. Okay. Again, that's why many clients that do a cash out refinance, it's called risk-based pricing based on Fannie and Freddie. So that cash out refinance, you can take that money out 6 months from now. You can do a rate and term, get your rate back down as long as interest rates are staying stable or in a downward market. So that's what many of my clients do that are looking for cash out, especially when rates were super low. If you can borrow at even 3% or 3.25% when rates were at 2.5%, you could reinvest that money and make more money on it. Still made sense, and then refinance 6 months later, right? It really depends on the person and their liquidity situation. You have a lot of people that want to keep building their portfolios, but don't have the cash to be able to do that. But we have record amount of appreciation in house values. So how can you increase your portfolio and double those rents coming in each month? Well, the best way to do that is a cash out refinance on that first investment property or even your primary residence, to be able to take that money and put that down on another investment that can increase your cash flow. It's a great product if used right and if explained right. You want somebody to look at your portfolio as short-term and long-term. Listen, I'm an investor. I have this property. I live in this property. Here's my equity positions. This is my long-term goal. What is best for me, both short-term and long-term? And a good lender should be able to put you in a position for that.
Yeah, that's great. Like it's a partnership, right? Like the partnership versus transactional right there is so important. Going back to one thing you said there, it's another comment. Everyone loves the BRRRR process. Everyone loves, hey, I'm going to put some money into this and then I'm going to refi out. But it's one of the most overlooked concepts is just paying closing costs again, having the higher rate because it is a cash out refi, potentially having seasoning. That doesn't mean you shouldn't do the process, but you just need to know those things going into it so you can underwrite accordingly. If you're underwriting at a purchase rate instead of a cash out refi rate, you're going to be highly disappointed when you get to that time to do the cash out refi.
Absolutely. And it's also part of acquisition costs, right? If you're looking at a portfolio, you can't look at it one transaction, right? If you have multiple transactions you're trying to simultaneously do with a cash out refinance to purchase another property, right? To me, some of those costs are associated with the purchase of the other property, even though they're on this property. So
yeah, I will pay this, but I will gain this.
Right. And here's the other thing. If you're pulling cash out of an investment property, now there's lower loan to value requirements. So please realize that compared to your primary residence. That it's an investment property that's also a tax write-off, right? So people always say, I don't want to show any money on my tax returns that I'm showing too much income, right? Because I don't want to pay the taxes on it. Well, there's some benefits also there in the short term during those 6 months to help offset and show a little bit more losses during your acquisition process to allow for a better return at the end of the year on your tax return. Again, I'm very fortunate with a background in economics and finance, where I understand kind of both sides of it. I'm not an expert in tax law, so please make sure everyone knows that. But I can definitely recommend things that will help you both short-term and long-term and kind of look at things as a financial planner's perspective to make sure you're being put in the best position possible.
Nice. Love it. Sure, we could go all day, but we're getting towards the end and we're going to move to the wrap up round. You ready, Tom?
Let's do it.
All right, Chris, as a producing area manager at Neighborhood Loans, what is your competitive advantage?
I think my biggest competitive advantage is trust, honesty, and that you can get a hold of me 7 days a week. I think both of you would vouch for that. I'm fortunate that I do a ton of work, ton of clients, ton of agents that I work with, that I can be truthful and honest with you on every single transaction, tell you if this is a good deal or not. From a company standpoint, I have the best team in the world. I have the best company that I'm working for. One of the fastest growing companies in the nation year over year, the last 5 years. So we're doing something right. But most importantly, you're not talking to somebody else. You can call my cell phone, text, email me. I go to bed at 11:15. I wake up at 5:30, 7 days a week. I'm fair game in between that.
Nice. That's perfectly rigid.
Chris, what's one piece of advice you would tell someone that has yet to buy their first property here in Chicago?
Don't be scared. Accumulate knowledge and realize that if you're with the right team, both agent and mortgage professional, that it'll be the best choice.
Awesome. What do you do for fun?
Coach my kids. I play poker. I'm a big poker player. A lot of times on Sundays, I play online. I've had some pretty good success winning a couple tournaments and cashing. And it's all math, right? So math is good for me, and it's fun to me. And I like to golf. But most importantly, family time. With 3 boys of my own. Those date nights with my wife. I'm not gonna lie. You take that for granted before you have kids. So to be able to get out once in a while, and I love my children, love going out with my children, but every so often you can get out just with your missus. That's the things that makes me happiest.
Are you doing the country club? What country club are you part of?
A Royal Fox.
Royal Fox
in St. Charles.
You gotta invite me out this summer.
Anytime, buddy. Anytime.
I'm
not very good at
Chris as your lender. You get a free round.
Yeah,
that's right. Mark never has to pay for anything.
All right.
What is a good book, podcast, or self-development activity that you would recommend to our listeners?
Oh, good book. We'll be honest, I'm not a big reader because I don't have enough time to do it. I'm a big kind of motivational quote on Twitter type thing, kind of get a daily pick me up that way. So I don't want to quote anything that I don't have prepared, but that's kind of me. I don't have a lot of time to read, so that's kind of one of my go-tos.
All right, keep positive information in front of you. That's the theme there. All right. Besides yourself, name one person in your local network you'd highly recommend to other Chicago real estate investors.
Well, obviously, in the past, I've always said, for sure, 𝗤𝘃 Realty. I know you're part of it. I'm not just saying that. I've been with you guys since the inception. I think I don't even know how many years that is. But for sure that and a good CPA or financial planner. If you don't have one, I don't want to upset anybody I don't mention. But a good financial planner and CPA to make sure that you are protected as well as your assets are being looked at correctly.
Any recommendations on that CPA? Do you got any?
I would, but I work with a lot of them, so I don't want to offend anyone because I pump out your podcast to all of my networks. So I have to be nice.
So we can't screw up your referral stream. All right, we got you.
Yeah.
That's good. Chris, thanks so much. You have provided a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Absolutely. I love calls, text, emails. 𝗤𝗵𝗶𝗵𝗁@thepuleogroup.com. You can also go to my website, thepuleogroup.com. I have a lot of great information on there. And I am always, even if you're not looking for a loan, you just want to, I love interacting with people. I love talking with people and getting to know their questions. And I would love the opportunity. If you have one, reach out, call, text, or email me. I'll give you my perspective. And if I don't know the answer, I have a lot of great people in my network to send you over to somebody that can answer a question that maybe I can't. But I can tell you what, your clients are already have one step ahead of everyone else by listening to this podcast. I've learned so much, even though I'm in this market, such great people that are on here that you guys bring on. Part of your network and your extended network with this podcast.
All right. He's got a guy.
I love it. All right. So our Chicago question here. And Chris, I did this one specifically for you. I see you coaching your kids football all the time on Facebook. So, and Mark, I'm not giving you multiple choice because it's a low number, but I'm going to give you a hint. The number is higher than you think. That's my preface to the question. So Chicago has this many major league sports teams. And so major league, so like the Chicago Wolves is not a major league sports team. The Kane County Cougars is not a major league sports team. But Chicago has this many major league sports teams.
I'll go with 8.
Mark, you want to throw a number out there?
Don't Google it, Mark.
No, I was counting on my fingers. That's what I was doing. Sure. I was counting on my fingers. 7.
The answer is 8.
What's the 8th one?
Puleo pulling it off.
What's the 8th one? I thought I beat it because I counted the sky and I counted the fire. Like those were like what's the?
There is a women's soccer team, the Chicago Red Stars.
Yes, there is.
What's it called?
So you have the Cubs, Sox, Bears, Bulls, Sky. Good call on that one, Mark. Blackhawks and Fire and the Red Stars.
Red Stars.
Now, Mark, I would have. I would not have gotten the Red Stars, but I thought we had the Chicago Shamrocks, that lacrosse team. So I would have gotten 8, but the wrong 8.
My kids have.
Why I have the Red Stars is because you have that stud defensive end that plays for the Texans. What's his name? His wife plays on the Red Stars, and he's always posting pictures of the two of them when it's his off season or when he can get to a game. He's in Chicago at the Red Stars games. So that's
so it's JJ Watt, right?
JJ Watt, correct.
Okay, yeah, I do remember now that you're saying this. I'm like, okay.
Good Night Chicago is the book that I always read my kids. And I remember that they have a page that goes over all the teams. I was literally picturing that when I was counting that on my fingers here below the screen. But all right, guys, awesome show. Chris, thanks for coming back. I'm sure we'll do this again soon. Tom, thanks as always. Listeners, head over to our merchandise store. We updated it. We're going to do some promotions here in March, as far as if you buy something off of the merch store, you get a 10% discount. And if you post it online, we'll throw another incentive or some sort of bonus out there. So thank you guys. And thank you, everyone. And we'll see you next week.
All right. Thank you, guys.